All right, we are in chapter 2 of intermediate accounting. This is the third video. So we are going to start talking about the general ledger. So the general ledger is going to keep a running total of all active accounts that you have at the time. That way you can check at any point and see what the balance is of the different accounts. And we're going to see later on in this chapter that we will then create the trial balance from the general ledger. So we also are going to have subsidiary accounts, and this is going to be accounts that fall below other ones, like accounts receivable. Because if you think about it, for example, here, accounts receivable for Young Counseling totals $10,000 at the end of the quarter. This is from 4 clients suffering with varying reasons to lie on a couch and chat. So we've got Martha, she owes $2,000. Bobby owes $1,500. Richard owes $2,500, and Dwayne, who has his fair share of times that he needs to talk, he owes $4,000. So you're going to see as an external reader of the financial statements the $10,000 accounts receivable, 10,000. But internally, they're going to have subsidiary accounts saying accounts receivable for Martha, accounts receivable for Bobby, because obviously we have to keep track of all of that as well. We can't just say, "Oh, Martha paid us." Well, we have 10,000 outstanding. I wonder how much Martha owed us. And we're going to do the same thing for inventory. Think about Walmart. I mean, they have like hundreds of thousands of items. And whenever you see their inventory total, that's just all we care about as external users. But internally, of course, they're going to have all of those thousands and thousands of items listed out individually. How many bars of Dove soap do we have sitting on the inventory shelves? How many bars of Dove chocolate do we have sitting on our shelves or back in the back? So they're going to have every item listed out in subsidiary accounts as well. And that's also going to help companies to understand how much money are we making on each product. And you learn about that in managerial and cost accounting, but not in financial or intermediate accounting. So subsidiary accounts are very important as well, but we're going to focus on the main accounts that fall in the general ledger. And you may remember that there are some accounts that are permanent accounts and others that are temporary accounts. So permanent accounts, they are always going to show a balance. We're not going to bring them to zero unless they legitimately reach zero. So this is going to be everything on the balance sheet: assets, liabilities, and equity. We're not going to, at the end of the year, zero out cash because, well, we want to start fresh next year, unless we actually zeroed out the bank account. No, we had money in the bank account on December 31st. That money hopefully is still there January 1st. If we owed somebody an accounts payable at the end of the year, we are still going to owe them at the beginning of the year. So those are permanent accounts. The only way that permanent accounts would be zeroed out is if they legitimately reach zero. We actually paid off all of our accounts payable. We actually spent all of our cash. That's the only way that we would see those reach zero. Then we have the temporary accounts. Those are going to be the ones that show up on the income statement, are going to show up under comprehensive income. So that's going to be revenue and gains, expenses and losses. So we do want to zero those out at the end of each year, and that way we can start fresh. Okay, we made all this money in 2025. Now let's start 2026 fresh, and we will start at zero and see how much revenue and how much we have in expenses in 2026. But what happens to that money when we zero it out? What happens to those dollar amounts? That's when they get put into retained earnings. Because remember, we are retaining some of our earnings. We are reinvesting, we're holding on to some of our profit. And that is what we do there. That's how retained earnings gets its balance. We're going to see that more later on in this chapter when we do our closing entries. So we've got permanent and temporary accounts. It's important to remember which ones are which. Basically, permanent accounts are balance sheet accounts, temporary are income statement accounts. So we are going to walk through several steps of the accounting cycle process. This is a long chapter, and I am going to break these different steps for the most part into different videos, because hopefully that way it will allow you to process what it is that we're looking at. but make sure you watch each of the videos to fully understand the whole process of the accounting cycle. So the first step is we are just going to identify any external transactions, anything that has to do with money, and how it affects the accounting equation. We've already done that to some extent. And then we want to obtain all this information from source documents. Source documents could be invoices, receipts, pay stubs, anything like that that helps us to back up what it is that we are reporting. That's why we don't like to use a ton of actual cash. We'd rather use direct deposits or checks because there's not a great, accountability there with using cash. And our step 2 would be to analyze the transaction to determine which elements are affected within the accounting equation. So we're going to go ahead and get started on doing this in this video. We've got our transactions. These will look familiar from the first video for this chapter. If you didn't watch that one yet, I would go back and watch the first video for chapter 2. And we're going to look at the accounting equation, which is assets equal liabilities plus equity. And we're going to see each of these transactions. How does it affect the accounting equation? And then how would that affect the debit or credit side of each individual account? So we got Misty Young. She invested $60,000 into her business, Young Counseling Services. So we already discussed how that would increase our assets because it's cash coming in of $60,000, and it would increase our equity, which really is common stock. So then we identify exactly which accounts. We said cash and common stock, and are they a debit or a credit? So we know that assets have a normal debit balance, which means they are increased with a debit. So cash would be debited for $60,000 for this first transaction. Common stock is a normal credit balance, so it is increased with a credit, so we credit common stock. And I've got the little number 1 beside these because, if you were actually doing these entries in the real world, you would have a date beside them. And we'll see that in a later video when we start talking about journal entries, but we would have a date, but for now I'm just going to identify them with a number. So then we borrow money. So you may recall that Young Counseling took out a loan from Sixth Fourth Bank for $30,000. So we know that they took out a loan, they got cash. So our cash is going to increase. We know if cash increases, it's with a debit. And liabilities is also going to increase, which is our notes payable, because that is a liability, has a normal credit balance. So we increase it with a credit. So our T account, which ultimately ends up being like our general ledger, very similar to it, is going to show the $60,000 that was initially invested, and now in transaction number 2, the $30,000 that we borrowed. All right, and we always want to make sure that our accounting equation balances. I don't have the common stock showing here, but we know there was another $60,000 credit balance in equity from our last transaction. So that means we have $90,000 on the asset side, $90,000 on the liability and equity side. So we're good to go. Then we had that transaction where Young purchased supplies from Blunder Paper Company of $2,000 on account. So we said, since it's on account, that means cash did not go out yet. This was an accounts payable because it tells us account. That means they still owe somebody. So we are going to be debiting supplies, the asset supplies. It didn't tell us they used all of this up right away. So we know that it must be a debit to supplies, the asset. If they said they used it all in the same accounting period, it would be supplies expense. And then we have liabilities because it says on account, so we're going to have to show that in accounts payable. Again, assets have a normal debit balance, so we debit supplies to show that that asset is increasing. And then accounts payable is a liability with a normal credit balance, so we're going to credit accounts payable. All right, remember this one? Young counseled a client struggling with the fear of demon teddy bears, earning $4,000 on account. So again, they have $4,000 that they have earned. So they're going to go ahead and show it in equity, which is going to be our revenue. But we haven't gotten the cash yet because it says on account. So that would be accounts receivable for us, because we are the ones that are entitled to receive this money. But since we already did the work, as we saw in chapter 1, that is when we recognize the revenue. We did our part and we trust that they're going to pay us. So we show it as accounts receivable, but we get to go ahead and show it as revenue. And remember, we always credit revenue when we earn it because it increases equity. All right, now it's time to pay some salaries. So we see that Young paid their 2 counselors a total salary of $2,000 for the first month. So they already paid them. So that means we're going to show cash leaving. Even if it was a check or it was direct deposit, it doesn't matter because we're still going to show it as cash. Anything that has to do with the bank account decreasing, we show as cash. The other side of this is going to be an expense. So we are going to be debiting our salaries expense. Remember, equity has a normal credit balance, but whenever we have an expense, we debit it because it's decreasing how much we have in equity. So we're going to decrease our cash and decrease our salaries expense, or decrease our equity by recording salaries expense. Then we have our final transaction. No, wait, I think we have 2 more transactions here. We have utilities incurred. So Young incurred utilities expense of $500 for the month. They will remit payment next month. Okay, so they've already incurred the expense, but they're not actually going to pay for it until next month. So we do have to show the expense in the same month that we incurred it. Again, we saw that in chapter 1. So we are also going to show a liability because we're going to have an accounts payable. We're not paying for it this month, but we will next month. And then the other side of that, of course, is utilities expense. We always debit expenses, and we're increasing accounts payable with a credit. All right, last transaction we're going to look at here, and I did it again. I left accounts payable up there. So Young paid the Blunder Company, paper company, for the supplies purchased earlier in the month of $2,000. So they're paying them, so cash is going out, and we're decreasing our accounts payable. So we've got cash leaving, but we are debiting accounts payable because it's a liability. It has a normal credit balance. We are going to debit it so we can decrease it. So we're showing, hey, we don't owe as much in accounts payable as we previously did. So that is walking through the steps of identifying how does each external transaction affect the accounting equation, and then which specific accounts, which specific elements of that equation are they affecting, and how so? Debit, credit, are they increasing it, decreasing it? So this is what we want to do in steps 1 and 2. Follow up with the next video so you can see step 3 when we're going to start journaling these entries.